colleagues, is Tusanang, Pinkas Machilu Sebata. I'm just going to be doing a video to illustrate my evaluation of UNP, UnitedHealth Group. I did some posts on Twitter. The first one was this one that I was doing a evaluation. The business model is very interesting. I'll touch base on that because if you look at it here, basically they are doing healthy care plans. So their business is sticky. People who join them, they usually stick around. It's not an easy thing to get in and out. Basically their business is on medical insurance. That's what they do. And yeah, from looking at these summarized fundamental numbers, everything adds up nicely. It's a big company. It's 300 billion. And what interests me is the PE is under 20. The PEG is under 1.5, which is fine by me. Debt is low, but I'll have to verify that with my own evaluation. And yeah, when I look at return on investment, it's not wow, but it's definitely great because the average should be around 8 and they are double that. So their numbers are looking fine. Sales growth in the past 5 years, about 13%. This is the annualized one, annual growth here. But for me, it's key, and I'll come and repeat this when I show you the evaluation. I used a growth going forward for the coming 10 years at 2.5, not at 13. Yes, they have had crazy growth, but sustainable, I think it's about 2.5. And yeah, this target price is for the analysts' mean target price. So when you average the analysts who follow this, their target price, that's not the value which they see. That's where they think the price is going to get to. It's at the top. It's close to its 52 high, only 2% of the high. And yeah, it has had a good run. So basically the company, the business model is great. It's not a company which is going to give you wow movements like Tesla, Facebook. No, it's better. It's down to 0.72. Easy going, stable. But if you know your game and the way I trade the companies, if I pick these bottoms here, I'll have a good run. 220 to 300. It's close enough to about 50 or so percent. Even if you missed this whole drop, which is difficult to do, and you come and pick it at 240, it ran to more than 330 there. So knowing what you are doing and using leverage, you definitely get good returns. Movement in stock is great. Year-on-year returns, performance for the year, it's about 32%. Year-to-date is 10%. But yeah, I'm not interested in those numbers that much. I want to see movement. Yes, I like them to be positive and in the upper teens to more than 20. Yeah. So technically, fundamentally, the business is sound, and from what they do, it's a simple business. They sign up people to cover them for medical insurance, and that's it. And most people stay long. Then the next part, I spoke a bit about cell divergence. If you can see here in the chart which I attached, basically I was showing that the price has been making highs since late November. It has made new highs. RSI has refused. Clear, strong cell divergence. And this is the part where I attached the evaluation, which I'll take you through. But if one wants to see it, you can just click on this link in the Google Drive. You'll get the full Excel spreadsheet and how it's connected. Yes, it's massive. But yeah, if you're inclined to go that route, do enjoy. And I'm not going to deal much with the technical analysis on this chart. I'm more interested in the fundamental valuation, but as I said, this is a sell zone. It's not a buying zone. So even if I come up with my evaluation, I'm trying to understand this business because I would like to get in when it's going down and turn up with it. It's a steady type of company which I would like to get involved in and definitely hold for more than a year to 2 years to avoid those taxi issues. Yeah, but let's get on to it. My evaluation, basically, most of these numbers are driven from the financials, the past 10K, where we are currently using trailing 12-month stuff. Let me just go and open it quickly, but I won't go into the details. In the last 10K, these are the numbers. You can cross-check there. And the last 6 months, the first 6 months of last year were these. The last 6 months were that. So basically, when you get here, you take the last 10K, you subtract the first 6 months, you add the current 6 months, so that you get a trailing 12-month using these numbers and a little bit of that. It's what is pulled through to my input sheet here. All the formulas are there, so if one wants to follow the formulas, you can tell where what is coming from. So there's no funnies there. Everything, you can track it back to the 10K or the 10Qs. And these formulas are linked in the spreadsheet. But the key part, which was a driving force for me, as I said, was this growth. What growth will one go with for the coming 5 years? I went with 2.5. I'm not very inclined, and I was really short on them because currently they're doing 5.78. But yeah, with this current environment, the health sector has been doing great, but that's not where I'm seeing them growing. All these other numbers are basically numbers which they posted. And these are standard numbers. This number comes from the spreadsheet. What I did is I populated it with all the standard numbers from 10K, and that they're operating in the US mainly. I did not even say any other country. I think it's predominantly or totally in the US. And then calculates for me the cost of capital, which is that. It's just the equity, market value of equity, debt, and when you average it up, the weighted cost of capital is 5.7 basically. Those are the inputs, and here I was calculating for the options. Other than that, I did not add anything else to it. Sorry for that. I'll just cut that one out. Yeah, that was my evaluation inputs, and the output which I got was 38865, which when you go to the chart is a little bit crazy. It's out there somewhere. It's not, yeah, that green line. So it's way above where we are currently, but yeah, that's where I see value. And I think I undercut them a little bit on what's expected as growth, but that's my evaluation, that's my story. That's how I'm seeing it. So, and this valuation is detailed, but anybody who is interested can go into the details. And the stories I'm talking to you, I'm telling you what I was thinking when I came with this company, what I think the business model is. So I did not include them there. And the cost of capital worksheet I've just explained a little bit. And yeah, the other part which I want to touch on is the optimal capital structure. Their capital structure currently is about 12. The optimal is 20, so there isn't much financial engineering here, and they're not using as much debt as they should compared to the standard. But that's good for them because I think when the market value starts dropping, this optimal capital might start going down also. So they have enough gap. They are not the type of company which is going to be squeezed because of too much debt in their books. They are well covered. Usually I would have expected them to be closer to optimal, but looking at where they are trading, making new highs, I think they're good enough. Let them drop first and see how far they drop. Then I can be in a position to criticize their optimal capital. But if I was a private equity investor, I would think about this one, but the gap is not good enough for me to go and find debt and come and leverage this and it's a big company. It's not an easy one to buy out. This is more than 300 billion. So yeah, it's slightly down on their below their optimal capital, but it's not trend much. It's not something I would go after. But I like that because my long-term plan is to buy this company. Yes, I'll benefit when they are going down by shorting it, but I'm just shorting it in order to minimize my cost of entry. Okay, skip that one. Looking at accounting ratios, when I calculate my return on invested capital, you'll notice that I remove some of the things and I use some of the information from the previous year. I come to a rate of return on invested capital of about 20. And if you compare to what FinViz got, it's about 60, and it's almost in the same range, no issues there. So it looks fair for me. They're doing fine. They're definitely making some money. It's way more than the cost of capital. And yeah, no complaints there. On return on equity, it's also in the 30% region. Doing great. So I have no complaints. My evaluation this is a very stable company. There is not much one can manipulate or deal with. But yeah, I love the company. I intend to hold lots of it, but I want it to drop from its all-time highs to a position where I can be able to buy it. For me, the buying zones will be when these start grouping at the bottoms here. When RSI starts hitting the lower range of 30, stochastic comes back to hit the 25-20 zone. That's where I would like to see. That's where I would be changing from a seller to a buyer. But yeah, the valuation is slightly under its value. From my story, you can have a different story, but I won't be a buyer for now. I'm definitely a seller with an intention of holding this company long term. That's my evaluation. If one wants to see the details, there they are. If you go into, you visit my Twitter account, you'll find it at thanks13, and you'll see this link here. And yeah, that's my evaluation. I like the business model. But I realize that it's in the sell zone. And even though my valuation is way up there, I would like to come and collect it at a much cheaper price where the margin of safety is way great. That's it. I'm trying to keep it brief, but that's my evaluation on United Health Group. I thank you. It's 2:09 p.m. Sebata. Bye-bye.